Thanks for tuning into this conversation with the management of KEI Industries. One, of course, the results came out after having a fairly strong FY23, wherein the revenues grew by about 21%. They've guided to about 16 to 17% revenue growth at 10 to 11% EBITDA margin. So, on the kind of order book that they are sitting at, uh, the conversation with KEI about the business prospects is a conversation in itself. We would love to understand from the experience that Mr. Anil Gupta has about what does he think about the nature of the capex cycle and the spends as well. So let's get him in on the show to talk about all that and more. Mr. Gupta, good having you. My name is Neeraj. Thank you so much for taking the time out and speaking to us.
Yeah, thank you very much, Neeraj. Thank you.
And Mr. Gupta, just starting off with whether you were by any stretch of imagination surprised with what happened in quarter 4 in terms of either client conversations or what you were able to deliver or the input costs, or was everything as per plan?
No, I think in fact everything was at per plan, and input cost was absolutely flat. In fact, it was little lower than the earlier 9 months of the year. I was not surprised, but due to the lower input cost, our actually sales also were down by at least 3%, 3-4% as compared to what we were ourselves envisaging. It was surely because of the input price, and I'd seen even the February was little bit slow in retail also, so that also impacted very slightly for the overall sale of quarter 4. But overall, for the full year, we did very well and grew by almost 20.7% as compared to our own perception of 18%.
Yeah, and I guess considering the quantum of order book that you're sitting on, Mr. Gupta, plus the fact that the advent in the increasing share of the retail pie of your overall book or your overall business would suggest that the 16-17% guidance that you've given, it shouldn't be too difficult to meet this, would it be? I mean, most brokers that I read have said that they have full confidence in the fact that you'll at least be able to meet this guidance, if not better this.
Yeah, we are always conservative in giving our guidance. So I'm very sure that we will meet this guidance. Now, your earlier comment was that how do you think about the capex cycle moving forward in this year and the coming years? You know, yes. Government and private industries are now injecting huge amount of capex in their projects. Once the capex cycle starts, you know, it goes on for a few years. It can't dampen just because in the next few years the perception about capex is going down. India being a large market and large infrastructure requirements, we have seen a very strong investments or capex by the governments in railways, in highways projects, and which consequently leads to overall economic development, in terms of real estate in the tier 2, tier 3 cities, people moving out of little bit of the urban areas and so as to settle down on a lower priced houses. You know, all these things has a very good, cascading effect on the economy, especially the investments in infrastructure. Similarly, you must have seen in the power, in the rural areas and in the urban areas, transmission and distribution strengthening is projects are being done by most of the discoms and transmission companies. And so far as generation is concerned, major push is coming up from the solar power generators, who are putting it huge capex in the solar power plants all over the country. Fourthly, in the, for carbon neutralization, in most of the thermal power projects, capex is being initiated to reduce the carbon emission from the end, rebuilding of the thermal power plants, because they will be needing a lot in for the base power capacity in times to come. And the PLI scheme, which is leading to good amount of capex by the private companies in the manufacturing. So these, you must have seen this Apple and all this MacBook, etc. They are all setting up plants in India And one of the reason is, China plus one policy. They want to shift some of the manufacturing base to India. So all these things are leading to, good amount of capex in the private and the government sector.
Mr. Gupta, I would love to understand how does an experienced player like you think through this, because the opportunity seems to be large and here and now. You have some capacities coming on stream for sure, which will allow you to grow maybe at this 15% northwards of 15% rate for FY24 and probably beyond. Do you get enthused to expand or hasten your capacities so as to take advantage of this and grow at a faster clip? Or are you per se satisfied with the base that you have, that you grow at about 15-20% for the next few years?
See, we are already pursuing a large greenfield capex in Gujarat, and which we will be starting the construction from June. And the capex approximately will be 1,000 crore over a period of 3 years, and which will commence in next one month. And we expect that first phase should be commissioned within 18 months period, and then consequently second and third phase after 6 to 9 months each. So that facility will give us another booster of production capacity close to, in value terms, I'm just saying 4,500 crore rupees a year in phases. So we will be able to grow our markets in India as well as internationally, as we are quite established in the many overseas markets as well, with getting a good boost on exports from Make in India products due to slowdowns in America or in Europe, etc., in terms of manufacturing, and also they're reducing their dependence on imports from China.
And hence my question, sir. I saw the Silvassa plant. I saw and the fact that there is this period of construction that you've spoken about. Of course, the Baroda plant, I believe, gets commissioned very shortly as well. My larger question is, if indeed the capex cycle is so long, you are such an integral part of almost any industry's capacity expansion plan, do you get enthused to hasten your capex and try and grow at a faster clip, or are you happy with this 15 to 20% growth?
No, we will definitely aim for 20% or more. We will definitely not satisfied with lower growth. Let's see how. If there are no hiccups from the supply chain or from the contractors who are constructing the project, we'll definitely try to improve our commencement of production by at least 3 months.
Okay. One word just before we talk about final thing on KEI as well, Mr. Gupta. One word on where within the Indian industry and customers do you see the largest capex thing from? Because we hear that the private sector capex, while started off in some sectors, is not quite at full pace currently. Can you give us some idea of what is the nature of the capex in India currently?
See, in India, the nature of capex at the moment, let me talk of first the petroleum sector. In the refineries, huge capex is being undertaken for the improvement of quality of diesel and petrol. This basically wants to make it BS6 grade so as to reduce the carbon emission. Second is, the highways, a lot of expressways are coming up, and when expressways comes up, lot of utilities are converted from overhead to underground, which involves substantial amount of cabling in these projects. Thirdly, railways. Railways in mainstream railway, every day this Vande Bharat trains are coming up. So I'm not telling that Vande Bharat consumes that much of cable. It is the infrastructure for that which consumes cables. Third, all these suburban trains, metro rail, and these kind of projects are undertaking, taking a lot of cables from our companies. Fourthly, in highways project, a lot of tunnel, ventilation projects are being constructed in the hilly areas as well as in the normal areas, which also involves substantial amount of cables. substantial augmentation of distribution, strengthening of distribution, and conversion of distribution, in the cities from overhead to underground is also a big chunk of cable consumption, and as well as the transmission, which in many areas where the ROWs are not there, so the conversion from overhead transmission to underground transmission is done through extra high voltage cables. So these are, and then coming back to industries, steel, cement, etc., are always ongoing expansions. That lot of investments are coming up. Otherwise, in mobile phones facilities, electronic goods facilities. If all this comes through, semiconductor facilities comes through, so these companies will be investing a lot in the infrastructure and will be consuming a substantial amount of cables to bring electricity to their plant and within the plant also.
Got it. Just one quick follow-up there, Mr. Gupta, if you don't mind. I didn't hear you speak about data centers with as much interest. Is it still at a nascent stage?
Oh, no. I forgot to mention, data centers is a very, very big opportunity because they consume substantial amount of power, and where the power is consumed, cable is there. So
Okay.
data centers is
It's already underway in a big way.
Yes, and it will keep on going.
Okay. So that was the first follow-up, and the second follow-up before I move focus back to KEI, Mr. Gupta. In some fashion, even this is KEI only, but there was a government statistic about how 70% of the buildings that will be there in 2030 are not even constructed in India. Does that mean that a construction stroke real estate boom, whether it's residential or commercial or a combination of both, would ensure that demand for the products that you are present in stays robust till a better part of this decade?
What you mean to say is not constructed in India. You mean to say that it will be manufactured in factories and then assembled at site. You mean to say that prefab buildings?
Maybe that, or maybe built from scratch, as the case may be.
But even if prefab building is there, wiring will be done at site. It cannot be done in the factories. So there will be no impact on the wire and cable.
Which is what I'm saying. So if there is such a large demand that 70% of this new construction will happen until 2030 and not even started as yet, does it mean that demand stays robust for the better part of this decade?
100%. The demand will still stay. See, our product is such that whatever investments comes in the economy in terms of whether private or government, the wire and cable will be an integral part for this.
Got it, sir. Okay, my final question then, and out of the blue, I'm throwing this at you, sir. But everybody expects you, by virtue of your past performance and the reputation that you carry, that you will grow at 15% or 20%. With standard operating margins, with steadily improving return ratios, course of the year after year. Where can the surprise element come from? Is there a surprise element that can come in? Just trying to understand that.
See, first of all, in our product, technology isolation may not be there because these are electrical cables. Like in telecommunication, we see wireless came. I don't know what surprise elements. Surprise elements can be plus minus 1% or 2% in terms of lot of fluctuation in the raw material prices, etc. Or you can say a sudden recession in the sudden recession, like nobody can predict. But I don't know where natural calamities or any force majeure condition which may temporarily impact the operation. I don't see any other sudden impact.
Okay. So steady as she goes, certainly the name of the game, Mr. Gupta. Thank you so much for giving us such a nice lowdown about what's happening in India and how will KEI benefit from it. We wish you all the best for FY24 and the years ahead. And thank you for speaking to us today.
Thank you very much. Thank you very much.
The pleasure was ours. Viewers, thanks for tuning in.